Silver just dropped 6% in under 48 hours, faster than any major prediction models accounted for. Traders on global exchanges are scrambling, automated stops are being triggered, and social media forums are exploding with panic. Meanwhile, gold barely flinched, holding steady despite identical market pressures. This divergence is not random. It signals a deeper structural fault in the metals market, one that is largely invisible to everyday investors. Right now, the market is behaving as if an invisible hand is pressing down on silver. The anomaly is clear. Gold, historically a safer haven during economic stress, remains relatively stable, while silver, the so-called poor man's gold, is hyper-volatile. Analysts who claim just normal fluctuations, are ignoring the forces at play behind the curtain. Over the past 3 months, physical silver inventories in key vaults in London and New York have mysteriously declined, even as reported industrial demand remains stable. Exchanges like COMEX are still showing heavy paper silver positions, contracts that exist far beyond the actual available supply. This is a textbook setup for a crash. When supply is artificially constrained and demand is misaligned, even small market shocks can trigger outsized reactions. Charts comparing the last 2 decades show an unusual trend emerging in 2025-2026. Silver's volatility index has spiked nearly 50% above its historical average, while gold's volatility remains within normal parameters. This divergence is unprecedented outside of crisis periods like 2008 or the silver bubble of 1980. What makes this particularly dangerous is the leverage positions on paper silver. Every surge triggers a programmed sell-off, creating a feedback loop of collapsing prices. History provides a roadmap for what might be coming. In January 1980, silver prices skyrocketed to nearly $50 per ounce, only to collapse almost overnight. That collapse was fueled by a combination of speculative frenzy, thin liquidity, and concentrated positions held by a few major players. In the months leading up to the peak, anomalies such as shrinking inventories, rising industrial demand, and extreme leverage were already visible. Fast forward to today, inventory reports, paper-to-physical ratios, and leverage positions are exhibiting eerily similar patterns. Unlike gold, silver has far fewer institutional holders and a much thinner physical market. This makes it far more sensitive to manipulation. Historical charts show that whenever silver's supply-to-demand ratio drops below 2.0, rapid corrections follow. Current ratios suggest we may already be below that critical threshold, and the implications are not minor. The forces behind silver's vulnerability are deliberate. Major banks, hedge funds, and institutional investors are controlling paper contracts, dictating price movements and suppressing rallies to maintain artificially low prices. When silver tries to rally, these entities sell off large positions strategically, triggering panic and automated stops among retail investors. This is not speculation. This is market control in action. Further evidence lies in trading patterns. Sudden spikes in volume that coincide with price drops, coupled with low physical delivery rates, suggest coordinated suppression. It's a shadow market, invisible to the average trader but devastatingly effective. The goal is not just short-term profit, it is to maintain control over an undervalued asset, keeping silver cheap while redirecting attention and capital elsewhere, often into gold or other more liquid instruments. As we enter the first quarter of 2026, multiple variables are converging. Industrial demand for silver is expected to rise due to renewable energy and electronics production. Meanwhile, inflation is spiking, the dollar shows signs of weakening, and geopolitical instability threatens supply chains. Retail investors, sensing opportunity, are entering the market in droves, unaware that their timing coincides precisely with concentrated institutional suppression. The stage is set for a potential cascade, a collapse far sharper than gold could ever experience. Every minor shock now risks triggering outsized reactions. Yet, despite the looming danger, mainstream analysts continue to downplay the signals, calling volatility temporary and normal. Those ignoring the patterns are about to discover just how abnormal this situation truly is. Silver's decline over the past month is not just a random wobble, it's a warning signal. Volatility spikes are being recorded in real time, with intraday swings reaching levels unseen since 2008. The anomaly is clear. Gold, historically the safer haven, remains stable while silver oscillates wildly. This is more than market noise, it is structural stress manifesting. The unusual divergence between gold and silver is sending a message few are prepared to read. Silver is far more exposed, far more fragile, and far more manipulable. Industrial demand is rising, and yet physical silver inventories continue to shrink. Photovoltaic panels, electric vehicles, and advanced electronics are creating consistent consumption pressure, and yet paper silver dominates trading volumes. For every ounce that changes hands in reality, 10 or 20 exist as contracts alone. This leverage amplifies every move, creating sudden spikes and crashes. Charts comparing COMEX data to physical vault holdings show a widening gap that has not been this pronounced since 1980. When supply and leverage misalign this severely, A cascading crash is almost unavoidable. The history of silver manipulation is long, but patterns repeat with brutal consistency. In the early 1980s, market manipulators capitalized on thin liquidity to trigger frenzies and collapses. Today, the mechanics are more sophisticated, but the psychology is identical. Institutional actors operate silently, shaping perception, controlling retail panic, and ensuring that silver remains undervalued compared to gold. Data shows repeated spikes in trading volume immediately preceding price dips, an unmistakable signature of coordinated suppression. Even the timing suggests intentional design. Weakness in silver coincides with periods of broader economic uncertainty, dollar fluctuations, inflationary spikes, and geopolitical tension. Retail investors, drawn to the narrative of a hidden opportunity, are entering markets at precisely the wrong moment. This emotional driver, fear of missing out, ensures liquidity for institutions to offload positions while prices are artificially held down. It is a feedback loop that punishes latecomers while consolidating control in the hands of a few powerful actors. Looking at charts from 2011 through 2025, silver has historically exaggerated economic signals more than gold. In every crisis, whether inflationary, geopolitical, or financial, silver reacts first and hardest. The current setup mirrors those historical precedents, supply to demand ratios falling below 2.0, leverage positions concentrated among the top 5% of holders, and rising industrial demand. Overlaying these trends with technical indicators suggests an unusually high probability of a sharp decline before gold experiences any comparable movement. The psychological component cannot be overstated. Silver investors believe they are buying into opportunity, yet the very narrative that attracts them, the inevitability of a rally, is being weaponized against them. Fear, suspense, and uncertainty amplify reactions, creating cascading liquidations that feed directly into institutional hands. Each dip triggers panic selling, while each minor rally is immediately suppressed. This is not chance. It is structural inevitability, a market engineered for maximal volatility and controlled collapse. As 2026 progresses, retail sentiment, industrial demand, and institutional control are converging in a perfect storm. Every new data point, whether it's inflation reports, ETF activity, or manufacturing demand, interacts with this fragile system. Even small shocks, like a single central bank announcement or a geopolitical tension flare-up, can cascade through the market, triggering outsized reactions. The stage is set for silver to experience a crash far more violent than gold's, exposing vulnerabilities in supply chains, investor portfolios, and global market confidence. The signals are unmistakable. Silver's exposure to leveraged manipulation, combined with industrial demand pressures and retail panic, creates a scenario where decline is not just possible, it is structurally baked into the system. Those paying attention now may be the only ones able to anticipate the depth and speed of the coming collapse. The final stretch of 2026 could redefine how investors perceive silver forever. The structural pressures are mounting daily, almost imperceptibly, to those outside the inner circles of institutional trading. Physical inventories remain thin, industrial demand is climbing steadily, and paper contracts continue to dominate price action. Every day that passes, without a major correction, only increases the potential energy in the system, creating conditions for a collapse that could unfold faster than even the most experienced analysts anticipate. Retail investors are entering the market with the expectation of gains, unaware that the very patterns that suggest opportunity are being used to manipulate them. Automated trading systems respond to volatility spikes, creating feedback loops that accelerate price swings. What appears as sudden panic is often pre-programmed market behavior triggered by subtle shifts in large institutional positions. Each micro-movement reinforces the perception of unpredictability, while in reality, the orchestration is meticulous and highly controlled. Examining the paper-to-physical ratio, the disconnect is staggering. For every ounce of physical silver available for delivery, multiple paper contracts exist, artificially inflating apparent supply while masking real scarcity. Historically, when this ratio reaches such extremes, corrections are brutal. The 1980 collapse serves as a warning. When the illusion of liquidity fails, prices freefall, and the ensuing panic spreads rapidly throughout both retail and institutional circles. The charts from that period show near vertical declines, a scenario that, given today's higher leverage, could be exponentially worse. Further compounding the risk is the timing relative to other macroeconomic factors. Inflation is running above expectations, dollar strength is fluctuating unpredictably, and geopolitical tensions threaten supply chains essential for silver-intensive industries. Each of these variables interacts with the leveraged, paper-heavy market in ways that increase the likelihood of cascading sell-offs. When industrial demand pressures meet the artificial suppression of price, the system becomes unstable, and minor triggers can escalate into a full-scale collapse. The human element amplifies the mechanical risks. Retail investors, influenced by fear of missing out, continue to pour capital into silver, reinforcing the illusion of stability. Institutional actors exploit this behavior, controlling liquidity and engineering minor rallies to extract maximum value before initiating downward pressure. Each corrective movement is followed by panic selling, and every panic wave is absorbed by those in control. The more investors believe in inevitability, the more predictable their reactions become, a paradoxical feedback loop that makes collapse almost certain. Technical indicators add another layer of urgency. Silver's volatility index has consistently exceeded gold's by a factor of nearly 2, while trading volumes show repeated spikes in the absence of corresponding news. Historical comparisons show that these conditions, when combined with thin physical supply, precede rapid declines. Institutional patterns, leveraged positions, and retail psychology intersect to create a near-perfect storm. The market is primed, the participants are vulnerable, and the energy for collapse is stored, waiting for a catalyst. As the crisis unfolds, the consequences extend beyond mere price fluctuations. A sharper crash in silver compared to gold would disrupt industrial supply chains, undermine confidence in financial instruments tied to precious metals, and expose weaknesses in portfolios heavily weighted in silver-based assets. Investors who fail to recognize the structural inevitability may experience losses far beyond initial expectations. This is not mere speculation. It is a systemic outcome supported by decades of historical precedent and current market data. The final, undeniable truth is this: silver's vulnerability is engineered, magnified by leverage, industrial demand, and human psychology. Gold, stable and heavily controlled, will not experience the same intensity. The divergence is deliberate, structural, and historically predictable. For those who have been watching closely, the writing is on the wall. Silver is not just at risk, it is on the brink of a collapse that could redefine the landscape of precious metals in 2026. The signals are clear, the patterns repeat, and the outcome is almost unavoidable. Silver's crash, sharper than gold's, is not a question of if, it is a question of when, and its impact will ripple across markets, portfolios, and investor psychology, leaving only those prepared to understand the inevitability as observers rather than victims.